Yeah, hello, welcome back, guys, to our webinar. And today we'll be talking about the types of charts, the trends, and getting started in technical analysis. Now, we've been discussing from last week. We talked about folklores and introduction to the charts. And this week we are delving a little bit more into the different types of charts, which are very, very essential when trading on the financial market. You need to understand all the types of charts and trends because on the forex market there are trends and we always obey trends, the uptrend, the downtrend, the sideways trends, ranging markets as the case may be. And there are strategies that we actually use in trading these trends. We talk about the ascending triangles, the descending triangles, and a couple of other things that usually make the market very, very top tier. So if you have been following us on our series, it's very essential, to make sure that you understand how it all works and be able to replicate everything that we are trying to get you to understand about the financial market. So let's kick off. Next page. Now we have different types of charts, and the price chart, of course, is the primary tool of the technical analysts. And as a technical analyst, there are a variety of formats. Most charts use a grid system in which the x-axis measures time, while the y-axis measures the price level, and the time increment of the x-axis can vary according to the longer or the shorter term perspective of the analyst. So charts can be constructed using price data for any interval, whether be it yearly, monthly, weekly, daily. The most common, of course, is the intraday, which is a 60 minutes time frame, 30 minutes time frame. I myself, as a trader, I focus mainly on the 60 minutes, which is a 1 hour time frame, and I cut it in between the 30 minutes time frame to be able to have a proper breakdown of the direction of the market. Now, there's a popular saying by Bob Dylan Fison that you do not need a weatherman to know which way the winds blow. But in the sake of the charts, you actually need to replicate this saying and this strategy, which Mr. Bob has already let us know at the tail end. Next page, please. Bar charts, very importantly, bar charts are by far the most common type of price charts. And in the bar chart, each day is represented by a vertical line that ranges from the daily low to the daily high. And the day's closing value is indicated by a horizontal protrusion to the right of the bar. Additionally, we have the day's opening value is often, but not always, indicated by a horizontal protrusion to the left of the bar. Figure 2.1 is a daily bar chart of an individual stock, and in futures markets, the opening and the closing prices shown on the bar chart are representing values which are usually determined by exchange authorized professional traders. And these things, of course, come in a particular contract or contrast, as the case may be, that approximate the average price during the first and the last minutes of your trading day. Now, the first and the last of the days as recorded by specialists in a particular equity. We have the daily bar chart is most useful for trading purposes, but the bar chart are very, very essential for us to be able to pinpoint, market precision and follow it each by each step to be able to understand where it's heading to before the close of a new bar and the open of a new bar as cases. So that's just it. Next page. Now, charts for longer data periods provide an extremely important perspective, and these longer period bar charts, for example, the weekly, the monthly, are entirely analogous to the daily bar chart, with each vertical line representing the price range and final price level for the period. Now, on the weekly or the monthly charts, the opening and closing prices are simply the opening price from the first trading period included in the bar and the closing price of the last trading period included in the bar. For example, each bar on a weekly chart would use the Monday's opening price and Friday's closing price. So these two prices interchange and give us the perfect movement, the perfect understanding. Now let's zoom a bit in and see exactly what we're talking about. This is a weekly, or let's say this is the monthly time frame. Sorry, yeah, the monthly time frame. And the opening and closing prices was simply opening, you know, price from the first trading period, which was, let's assume from the start of the year. This is December. This should be January at this point here. And we had a first trading period included in the bar, and the closing price of the last trading period included in the bar. For example, each bar on a weekly chart would use Monday's opening price and Friday's closing price, which of course is what we're seeing here. So if we had to test this at this point and then have an extra one or two more positions and have the trade run down to this point, we'll see that we are expecting these longer period bars to keep shooting up for the longer data periods, providing that we have an extremely important perspective to what the chart patterns are currently showing. Now, with this being said, we understand the value of the movements of these charts and not to understand how it all works. Not to understand how it all floats with the indifference that comes from this and the other charts, right? Yeah, next page, please. Now, we are in the next diagram we should be showing you is the weekly bar chart of a stock picture, a stock market, and the segment within the rectangle corresponds to the period captured in figure 2.1, and figure 2.3 is a monthly bar chart for the same stock, and the large and small rectangles enclose the periods depicted by figure 2.2 and figure 2.1 respectively. Now, using combination, we have the monthly, weekly, and the daily bar charts provide a telephototype phototype effect. The monthly and the weekly charts would be used to provide a broad market perspective and to formulate a technical opinion regarding the potential long-term trade. Now, the daily chart would then be employed to predetermine the timing of your trades if the long-term technical picture is sufficiently decisive. Now, we have the trader may already have a strong market bias by the time he or she gets to the daily charts. And for example, or for instance, if the monthly and the weekly chart suggest that the markets has, witnessed a major long-term top, we have the trader will only have to monitor the daily charts for sell signals or anything of the likes. Okay, next page. Now, having a more look at the chart, we have the difference in perspective between daily and weekly charts can be striking because both types of charts should be examined. For example, we have the daily bar chart for the March 1995 silver contract. This was back in the 90s, of course. We had it being dominated by a very bearish massive top pattern. And the weekly silver chart, however, provides a very different picture. Although in this chart, the late 1993 to 1994 price pattern still looks toppy, and the chart also reveals that prices are near the low end of a broad historical price range, and that a major price base was apparently formed during the 1991 to 1993 early period of this trade. Now, let's understand this perspectively and understand where this chart would have possibly ended up in. Next page, please. This is a weekly bar chart, by the way. Now, with both, next page, please. Now, close-only charts, as the name implies, close-only charts are based on the closing values. Let's ignore the high and low prices information. Some prices series can be dissected or depicted in only close-only chart formats because intraday data are not readily available. Now we have two examples, which are one cash price series, and which you are seeing in figure 1, and we have another one which is supposed to be our next page. This, of course, is the cash price series, as we can see. The page being highlighted. Next page, please. Yep. And then we have the point and the figure charts. Now, go back to the previous page. Now, about cash point prices, we have a spread chart that depicts the price difference between two instruments because some chart traders may prefer close-only charts even when the high-low close data are available because they feel a clearer price picture can be obtained by using only the close, and in their view, the inclusion of high-low data only serves to obfuscate the price chart. And there is much to be said because from the emphasis on the closing value as the embodiment of the day's essential price point information, we have nevertheless many important chart patterns depend on the availability of high-low data, and one should think twice before ignoring this information. Furthermore, as a practical matter, bar charts are far more readily available than the close-only charts. So it's best we understand these things and understand how they work. Okay, next page. Now we have the point and figure charts. We have the essential characteristics of the point and figure chart, which is that it views all trading as a single continuous stream and hence ignores the time. A point and figure chart consists of a series of columns of X and O's, and some types of charting software use rectangles or other symbols instead of zeros because each X represents a price move of a given magnitude called the box size. And as long as prices continue to rise, we have X's which are added to the column for each increment equal to the box size. Because however, if prices decline by, let's say, 1 inch or 2 inches or one full pip or 100 pips, it all depends on the particular entry point and the exit point, of course. Next page, please. Now, for example, the next page will be seeing figure 2.8 uses a box size of 0.5 points and a reversal size of 3 boxes, which continue to be added for every 0 to 5 point price until a drop of 1.5 points or more occurs. And that point, we have a new column of zeros which begins and starting 1 box below the last X. And as noted, the point and figure charts do not reflect time. One column could represent a day or several months. And we have figure 2.9, which shows the bar chart corresponding to the point and figure chart in the previous figure. Now, we have columns of O, which is started and plotted downwards, while the number of O's depend on the size of the reversal, which what must be at least equal to the reversal size by the convention, because the first zero is placed 1 box below the last X of the previous column. And the same logic should always apply to downward moves and upward reversals, and the choice of box and reversal size is arbitrary, to large boxes size, filter out more short-term noises and all of that. Next page, please. Now, we have both the single day on the bar chart, which is denoted by the symbol 1, and then the immediately subsequent 5-day period on the bar chart, which is bracketed by arrows and labeled with the number or the symbol 2, which corresponds to single columns similarly marked on the point and the figure chart. Understood? Next page. We have candlestick charts. Importantly, these are one of the most famous kinds of chart because candlestick charts add what we call dimension and a bit of color rather than the simple bar chart. Now, this segment of the bar that represents the range between open and close is represented by a two-dimensional real body, while the extensions beyond this range to the high and low are shown as lines called shadows, and a day on which the open and close are near opposite extremes of the daily range, we have a large real body, whereas a day on which there is little net change between the open and close will have a small real body. Now, the color of the real body indicates whether the close was higher than the open or lower than the open. And the next figure, the next table figure, is a candlestick chart of the middle portion, which may signify late May through early September chart pattern of 1996. And let's check out figure 2.9. Next page. Yep. So if we have to zoom in, we can see that this is a cash price chart on wheat. While candlesticks charts use the same price data as bar charts, their unique display of these data highlights distinct reversal and continuation patterns that candlestick analysts rely on to gauge market behaviors. Now, a detailed description of the married candle patterns and their respective interpretations is beyond the scope of this discussion. But as one illustration leads to another, a candlestick that has the same opening and closing price is of course called a doji because it's so slim. And an example is provided by the dramatic wide-ranging day figure in figure 2.12. And dojis are traditionally interpreted as manifestations of uneasiness or indecision in a market, and in a trending market, may one or of an impending or intended trend change, which might have to outturn and outsmart different ways traders think and how traders actually view the markets. Okay, next page, please. Now, the doji, which is a very significant candle on the charts, which signifies indecision, by the way, the only candlestick that appears identical to its bar chart counterparts. We have insofar as candlestick charts show more information than bar charts and offer an alternative visual depiction of price data. Some traders may find these charts more natural or useful than the conventional bar charts. Next page. Now, when analyzing any type of data or charts, it's important to understand the nature of the price data you are studying, and the following sections address some of the often overlooked data issues for stock and futures traders, especially and respectively, because for stock traders only, we have stock splits and price data. But when the price of a stock splits, all past prices are adjusted proportionally so that the split itself does not cause any price change. For example, if a stock trading at $50, witnesses a 2-to-1 split, the current price becomes $25, and if no adjustments were made, the chart will reflect a price move from $50 to $25. And to avoid this absurdity and distortion, all past prices will be divided by 2 to split the ratio. Thus, while past prices prior to stock splits would not reflect the actual stock prices at that time, the series will be affected by only true price moves as opposed to moves due to stock splits. And although the method of adjusting stock price series for stock splits is sensible, it is important to realize that past price changes implied by a stock price series may dramatically underestimate or understate the actual changes that occurred. So let's understand this that way. Next page, please. Now, let's take, for instance, the point of figure chart here. For instance, if a stock had 2:1 split, prices would have been adjusted by dividing by 2, 4, or 8, depending on when the split occurred. And a price move from $5 to $8 before all 3 splits would actually reflect a $24 gain, not $3. Why this doesn't affect price patterns much, it can distort back-tested trading results. To reduce this distortion, we have used fixed dollar positions, e.g. $1,000 per trade, instead of a fixed number of shares. For example, we have a $5 per share. You would buy 200 shares at $50 just for 20. Okay, understood. Next page. For futures traders in loan, we have what we call the linked contract series. Stock charts represent constant on the unbroken data series which is not the case with futures contracts. Commodity and financial futures are traded on a recurring cycle of contract months, each with a finite lifespan and distinct but usually related prices, for example. Now, what is commonly called the quarterly cycle with contract months of March, June, September, and December, crude oil by comparison has a contract for every month of the calendar year. We have futures trader who holds a long-term position must roll over the trade, that is, liquidate the position in the expiring contract month and re-establish it in a more dimensional way. Next page. We have the weekly or the monthly bar charts, which require combining a series of futures contracts, which is crucial for identifying long-time tops, buttons, and key support resistance levels. We have a key challenge in futures chart analysis, which is the short lifespan of contracts, and even the shortest periods of active trading in many markets like currencies, stock indexes, activities, which is mainly focused in the in the interest of the nearest 1 or 2 months. But in some like foreign bond futures, we have almost all trading occurring in the front month, leaving unusable data for only 1 to 3 months. So this makes it nearly impossible to apply most charting techniques to single contract charts. But even when a contract has a year or more of liquidity, proper analysis still requires multi-year weekly and monthly data. Therefore, linking successive contracts into a continuous chart is very essential, because both in markets with limited data and those where longer term analysis is needed, it's very advisable we understand how all these things work. Next page. All right. Now, here's a brief understanding and explanation about candlestick charts. Some people usually redesign their own theirs to be green and red, while some people leave it white and black as a default. But what it actually means, this is a bullish candle and the other one is the bearish candle. Now, you open at the below or at the bottom and it close at the top. That's for the bullish candlestick. Candlestick chart with a wide real body up day. It opens at the bottom, which is the low, and closes at the top, the high, which is the close, right? But for the bearish, it opens at the top and closes at the bottom, which is, you can see the difference between the two candlesticks patterns and types. Next page, please. Now, futures contracts are typically combined using the nearest futures approach, plotting each contract until expiration. Then you have switching to the next. However, this method can create distortions due to price gaps between contracts. But we have our next page, which illustrates this issue, showing sharp single week rallies occurring every 3 months, and these weren't actual price increase, but artifact caused by rolling into the next contract, which consistently traded at a premium. But in reality, prices declined during this period. A long position rolled from contract to contract would have lost money. But this is clarified in the next figure 2.4, which shows a continuous futures chart for the same period, eliminating the misleading spikes seen in the nearest futures charts. Next page. As explained better, we have a continuous futures chart here currently looking at us, closely mirrors the equity changes of a continuously held long position, and the sharp gains shown every 3 months in figure 2.13 are misleading, of course, because traders couldn't capture these profits because they would have exited a lower price contract and entered a higher priced one. And these phantom gains stem from price differences between contract months, because nearest future charts can show price movements that don't reflect actual trading results. As seen in the Euromark example, an alternative is actually needed, and the continuous futures charts avoid this distortion and offers a more accurate view. Next page. Now, here is, we'll be talking about continuous futures. A continuous futures series links successive contracts while eliminating price gaps at the rollovers. Now, this is done by adjusting the new contract prices by the difference between the old and the new contracts at the rollover point. For example, in building a continuous series for COMEX gold using June and December contracts, supposing June gold closes at $400 and December at $412 on the rollover date, the $12 difference is subtracted from all future December contract prices. And if at the next rollover, December trades at $450 and the next June at $464, the $14 difference would be subtracted from future June prices, maintaining a smooth gap-free series, which is about $438, of course. Next page. On the second rollover date, the June contract trades $26 above the adjusted series, so all future prices from that contract are adjusted down by $26. And this adjustment process continues based on cumulative differences at regular rollover points. Usually the entire series will then be shifted by the total adjustment to align the current series price with the current contract price without altering its shape. Now, this eliminates distortions caused by price gaps at some sort of rollover. But in markets where nearby contracts often trade at premiums, we have cumulative adjustment, which can cause negative prices in past data. While this may seem odd, it doesn't affect system testing. Traders simply ignore any unrealistic or negative support levels in chart analysis. Next page. Constant forward perpetual series. Now, a third type of linked future series is the constant forward or the perpetual series, which represents prices at fixed time, held and created through interpolation between two contracts. For example, a 90-day forward price might best well be calculated as 2/3 of the nearest contract and 1/3 of the next, with weights shifting as time progresses. Now, this method avoids large price gaps at rollovers and improves on nearest futures. However, it has two key drawbacks, which is not tradable since it doesn't represent a real contract, and it ignores time decay effects in actual futures, which can cause its price patterns to diverge significantly from real market behavior, making it unreliable or analysis or backtesting or some sort. Next page, please. We have a linked futures price series which can accurately reflect either price levels or price changes, but not the both of them. Nearest futures show actual historical prices but distort price swings. Continuous futures accurately reflect price swings and thus trading equity changes but not the historical price levels. Constant forward futures reflect neither reliably. Because only continuous futures reflect true price swings, they are essential for accurate system backtesting. Actual contracts are unsuitable for backtesting systems that require more than 6 months of data, and using many individual series is inefficient. So, which is better for chart analysis, nearest or continuous futures? Like choosing between price and quality when buying a car, both actually matters because each chart type reveals different insight and has its own weaknesses rather. And using both together provides a fuller picture as they can show very different trends. Nearest futures are most commonly provided by data vendors, although many also offer continuous or constant forward series, given their differences, which is very important to know which type you are actually using. Next page, please. Now we move down to trends. Defining trends by highs and lows, because market trends offer the best profit opportunities, and the most basic goal of the chart analysis is to define, identify price trends. One standard definition of an uptrend is a succession of higher highs and higher lows. For example, in the next page, during the March-September period, we had relative highs and higher than the preceding high, and each relative low is higher than the preceding low. In essence, an uptrend can be considered intact until a previous relative low point of reaction is said to be broken. Next page, please. So that's it for today on our technical analysis series, and we are going to see you guys again next week. And I hope we really understood something from this. Thanks for joining. Thanks for joining us today and last week. And we continue the series again next week, Friday. Have a wonderful weekend and a wonderful Eid celebration. Bye bye.